Okay, we are live, Anjali.
Hello, hello. Welcome, product community, to yet another live streaming by Product People. It's really nice to have all of you here. So, good morning, good evening, and good afternoon to everyone from wherever you're joining from. So, before we begin, just a quick ask. We do use slido.com for two reasons, and that is first for our icebreaker poll that we have, and second for questions that you would have that you would want to present to our speaker. So that being said, the way that you can join on Slido is by two means. And the first is you could scan the QR code that you see displayed on the screen and then directly go to Slido. Or if you would like to go the old-fashioned way, you can directly go to slido.com and enter the code 1583527. Also, we are streaming live on YouTube, LinkedIn, Twitch, and Facebook. So if you have any friends that you would want to call over, please do. And we'll also be recording this session, and it will be available on our YouTube for later reference. So make sure that you tune into this channel if you want to catch us live. So that being said, we have a very interesting topic in the lineup for today, and that is finances for product managers, navigating financial terms for greater impact by Alex, who is a product and tech leader, an advisor, and an investor. And it's definitely a very interesting topic to learn more about. So that being said, a very quick intro about your host today, and that's me, Angelina. So I've been in the product management and business analysis verticals for 5+ years. And I come from a background in business information systems where I naturally transitioned and went up in terms of what I did. And that's like a very brief about me since you're not here to listen and get to know me. Moving on. So in terms of product people, we do interim product management, product leadership, and product operations. And we also have one of Europe's largest product management communities with over 33,000 members. So something that we generally do and love doing is spreading knowledge. And in that, we do have free talks, free events and talks for the community, just like this one, which we organize to make sure that we always bring the brightest and boldest topics in product management to you. So that being said, we're going into the icebreaker poll where we want to get to know you and understand you, and especially to give Allan a bit of knowledge into who the audience is. So the question is, what's your favorite part about being a product manager? Profitability and profit margins, budgeting and forecasting, what investors look for, evaluating ROI of product features. So please feel free to use Slido for this purpose. You can either scan the QR code or go directly on slido.com and enter using the code 1583527. I see that there are a couple of answers already rolling in. It's super exciting to see that you are all replying and answering to this on Slido. So I'll just pause here and give you some time to gather your thoughts before we answer the specific question. Cool. And the results are in. So 40% of the audience says profitability and profit margins. 80% says budgeting and forecasting. There's 0% that says what investors are looking for, and 100% that says evaluating ROI of product features. So that being said, I'll be handing over to our speaker for navigating financial terms for greater impact. Over to you without further ado. Thank you.
Great. Thank you so much for the introduction. Real pleasure to be here as well. Let me just see if I can sort out the technology with sharing my screen, and then we can make a start. Okay, so here we go. Navigating financial terms for greater impact. finance is everywhere. I think it's really important that people understand these financial terms, especially product management. But before we start that, let's take a little quick look about who I am, because you probably haven't heard of me before. Here I am coming up on your live stream, and you're wanting to know a little bit about my background and why this is a particular passion of mine. So I've been in tech since 2002. I primarily worked in startups since starting in tech all that time ago. I've been in product management since 2012 as well. So I've got a fair amount of experience, and I've been able to see how some of the startup scene and how product management has changed over time. I've been doing product management. I'm originally from the UK, but I've been doing this almost exclusively in Berlin. I became a consultant and freelancer in 2020, and I work with SMEs who have some form of digital product. So SMEs I'm counting here generally as companies which are startups that have graduated on to starting to become more established, and they are generating revenues. They have some form of product market fit, and they're looking to take the next steps with growth as well. So I'm working with companies that are somewhere between 50 and 150 people. They often have financing as well from VCs. Why am I talking to you about finance when my background's really in product management? Well, I've worked on financial products. So I've worked in fintech companies. I've also worked in financial management as well. Either I worked in a finance office, looking at budgeting and how the organization was using resources. And then also as part of the leadership roles that I've taken on as well, I've been involved in much of the finance discussions that have gone on there. And it really opened up this world for me as well about how we can think about finance and use that to help us make decisions too. On the side, I'm a bit of an angel investor as well. When I have the opportunity, when I have the money, I really love seeing what new companies are up to and how I can help them, both in terms of offering them advice, but also offering them some financing when I can. On the side, I'm a bit of an armchair investor as well. So I like taking a look to see what's happening in general in the markets, especially with larger companies. We'll actually cover some of that today as well, taking a look at a couple of big companies that you will almost certainly recognize. Everybody likes logos. Here are some of the logos that I've worked with. Those of you in Berlin, you might recognize Urban Sports Club. You might recognize Lingoda as well. You might recognize Got Photo is a little bit niche in the SaaS business. The other names there are from other clients that I've worked with, and not all of them are household names, but they're all extremely interesting companies to work with. Okay, so understanding finance is really important in product management, and it's actually probably now more than ever an important topic to get your head around. And I don't think it's really a mystery about why it's important. So interest rates increased in 2022, and this made financing much more expensive for companies, especially if they're being financed by venture capitalist companies, for example. And with high interest and less financing available, it meant that they couldn't make as large losses as they have done in the past. And so it reduces their ability to invest right now. And this means that these organizations have to make more efficient use of resources. So maybe in 2021, as a product manager, it was great to talk about engagement, product market fit, understanding the user, and maybe less so thinking about some of the financial implications of the decisions we were making, because the growth was going to come. Now, where we are at the moment is product managers can really benefit by having a wider view on costs and revenue within their organization and where these are generated, because when resources are tight, then we need to think about how we can use them the best way. And if we're only thinking about very sort of core product management topics, we might not have that view that will help us make those good decisions, and also have that influence with managers and leadership and boards who may be talking in very financial terms that we might not be familiar with. So let's start off and have the question, like, what is finance? It might seem rather philosophical to talk about what finance is. And I spent some time thinking about this and coming up with a definition that would help us today. So I would see it really as modeling how resources are gained and used within an organization in order to make decisions. So sometimes we'll see past accounts and what's happened. And this is really just a model of what's happened to money in an organization in the past. If you look at something like the bank account, it's not necessarily always easy to see how the revenue came in, how it was spent, what happened. Whereas when we have a nice set of management accounts, we can actually see and have a model and a concept for how that is handled. When we look at budgeting, what we're looking at is a forecast in terms of what we expect to be gaining in terms of revenue, and we have a plan on the money that we'd want to spend on staff, on buildings, on buying things. And that's where also this modeling is really important. So if we define finances thinking about how resources are gained and used, then I think that's a great place to start from. So rules. I love rules. There's 3 golden rules I think every product manager should understand about finance. First of all, finance is really an art rather than a science. So it's all about the definition. It's all about how we define the money that's coming in or going out of our organization. And there's some wiggle room there, and there's some definitions that we need to think about. And those definitions and those terms will depend on whether you're in the US, Europe, and the UK. So we all have slightly different words for many of the same concepts. And nobody should get too scared about what all of this terminology means and which words mean the same thing. The best thing to do is just to start becoming exposed to it and getting a mental model about how financing works. Some are very industry specific. So if you're working something like SaaS, there'll be some very sort of SaaS terms in there. If you're working with e-commerce, there'll be some very e-commerce terms in there as well. If you're working in other parts of the economy, like construction, I'm sure there's very industry specific terms that they use as well. Next one is company specific. Your company will have its rules about how it defines different parts of your financing and what those metrics mean. So you'll have those KPIs down and they'll be very specific to your company, and they might have evolved over time as well. And then the last one is there's tax accounting, there's management accounting. It's easy to confuse the two, but basically we're going to be talking about management accounting here. What's sent to the tax office, they sometimes have some different rules about things. So that's quite dry. Let's go on to rule number 2. Rule number 2 is there's always a tax somewhere. Don't forget that there's a tax somewhere. There always is one. It's a very good idea to sort of be aware of it. If anyone here has worked on pricing, you will probably have come across some of the sales taxes that are involved, and getting those calculations wrong can make a real difference to your profitability. So there's always a tax somewhere. Just remember that one. And the third and really the most important one, and the one that you should just definitely go away with, is always ask questions. So there'll be people in your organization who'll be able to help you. You can speak to the finance team, for example. So finance team, you'll be able to speak to your data team about definitions, and your data team will be a really good resource as well, because they often have to come up with the numbers and those definitions. And the last one is the management. So the management is all about setting those goals. So always ask questions. Those definitions change, and it's just a lot to take on. So be curious and find out what's going on there. So terms. We'll come across a lot of terms today. As I said, don't worry about them. Try and get the concepts behind them, and the terms will come later. So let's start off. There are 2 sides to financing of an organization, 2 ways of looking at them. If anyone studied business or just sort of listened to the news, maybe taking a look at investment just in some very basic ways, you've probably come across these terms before. So one side is called profit and loss, and I love to think about this as being a river. So this is the money that comes into your organization right at the top here from your customers. It flows all the way through, and it flows and it nourishes the different departments along the way. So you'll have your different departments who'll be taking something here. So you'll have sort of marketing, you'll have maybe software engineering, and you'll have these costs that come out. And then at the end of this stream, this river, you will have your profit, and the profit will then be used, and it can go, for example, to the owners. It can be reinvested. So this is the profit and loss account. It happens over time. People talk about this company has made €1 million in profit this year. And that is what they're talking about, this stream, this river of money that flows from the customers out to profit at the end. And this is the one that we'll probably be mostly talking about, and is the one that you'll probably be most talking about in your job as well, because this is where the interaction happens with the customers. It's where you're making choices about spending money or not. The second one is about the value of a company. And this is like weighing something. How much is this company worth? And we'll often talk about this as being the balance sheet. You might have come across this term before. And this is really taking a look at what does the company own and who does it owe money to? And the more things it owns and the less money it owes to other people, the more valuable it is in general. Now, the value of a company is important if the owners want to sell it, if it's on the stock market, for example. And it's very much based on opinion as well. It's what value would you put onto this company and how much would you pay for it? That said, we'll be mainly looking at profit and loss today, and we'll be going through this flow of money. Okay, so let's start off. We're in product management, so we love funnels. And this funnel is sort of the granddaddy of all funnels. So what we're looking at here is the top of the funnel where we get money from customers. So we get money from customers up here. And then at the bottom, all the way down here, we will have our profit that will come out. Whoops. We'll have our profit that will come out. So when we take a look and we are creating and understanding how much profit we're making, we need to take all of the costs away. And we start off with the costs which are most relevant to us making one particular sale. So the money that comes in from the customers is called revenue. And sometimes it's called sales. Then what we'll do is we'll have some taxes that we'll need to pay. So again, if you're involved in some sort of retail, you'll know that, for example, you've got VAT, and in the States or Canada, you'll have sales tax. So in Germany, for example, this will take about 19% of the money away. Straight away, it's gone. Then we'll have some costs which are related to credit card processing, for example, and payment processing. And this might just be a couple of percent, but in some industries, that those couple of percent is really important to actually us knowing if we've got a profitable product or an unprofitable product. Next, we have to buy the things that we're going to sell. So let's say that we're doing e-commerce, then we'll have to buy whatever widgets we're going to then sell out and sell to the customers. And this is a real direct cost, which is related to the business. And then so this is the cost of all of the things we sell. And these costs at the top here are making what we would call the cost of goods sold. And then between these, we will actually have what you might hear referred to as something like the unit economics. So it's how much money do we keep after we have sold the item to the customer, which are most directly related to that particular sale. You might also have things included there, for example, at AWS or OpenAI, you might have the electricity costs that will be included there, et cetera, et cetera. Then we start going on to other costs. So these are the more fixed costs. So we have staff in here. So the staff might be, for example, related to software development. Further on up here, we might also have marketing costs, which are included. So the marketing costs that are included are generating us those sales. We might have a building that we run. So these are the costs which are much more difficult to assign just to one sale. And these are the fixed costs. Finally, we go on to then paying some taxes, because there's always taxes to pay. And we might be paying for some financing as well. So in general, this is what your profit and loss account will look like. So if you hear people talking about things like gross profit, unit economics, then they're talking about the first part here. And if you hear them talking about things like net profit, then they're talking much further down here. And you might have heard the term EBITDA as well, which is thrown around everywhere. And this is the earnings before you pay those taxes and some of the financing costs of the organization. Many top leadership are doing or are given targets which are based on this profit called EBITDA. Okay, so now we've seen quite a technical funnel, which is taking our profit that the revenue that we have at the top, taking it all the way down to profit at the bottom. That's then paid out to the owners. Now, what we start seeing is actually in most companies, there's only two things that matter. And this is really where a lot of the product side of things comes in as well. So there's the cost of acquiring customers, sales, marketing, et cetera, and then there's the amount of money that you're going to get from your customers with the time that they're with you. So this is the revenue minus those costs that you see at the top, the cost of goods sold, and those ones that make your gross profit. And this is really the sort of equation that we'll probably spend most of our time looking at. So one of the questions I always ask is, what's the cost of acquiring customers? How much are you paying to get them? And how much money are you getting from them? So there's only two questions we can ask. Are we going to reduce the cost for getting customers, or are we going to increase how much we're getting from them? This, of course, depends on the business model, and each company has a very different business model. And I've sort of shown this as an extreme or a scale. So on one side, we'll have something really specific, like specialized construction. So this will be people who are building really specific buildings. It could be something like an opera house. It could be your house that maybe one time in your life you are going to get somebody to build this. And this will mean that you might have a relationship with this customer only once ever. And you'll have this relationship once, and that's it. You'll also probably have very high costs that are associated with building this particular building. It'll be all the materials that you're buying in. And you might even be having quite low profit margins because of this. So this will have very high costs, and it will have probably very low margins. So profit margins will be quite low. This is one extreme. Then we go into something like retail, and retail has some reasonable costs. It's got quite low margins. This will be like a supermarket, for example, and they'll have to have things like buildings and staff to pay for. If we start going to e-commerce, we'll also have these things that we need to buy, and we'll need to be sending them out to people. So we'll have logistics to think about, but we won't have any stores to run. We won't have any staff in those stores. We have some warehouses. So here we might have slightly better margins because we have fewer costs. But the issue there is we have to get customers somehow. And sometimes getting customers online can be very expensive compared with if you're running a shop and it's in a physical location. We then move on to one of my favorite areas, which are two-sided marketplaces. So many businesses are what are called two-sided marketplaces. And these are really just putting one group of people who have something to sell with another group of people who have something to buy. And they're great. They're wonderful, interesting businesses. I really like them. And there'll be things like Uber, which is putting people who have something like a taxi in contact with people who want to ride. If you're in Berlin or another place that has urban sports, then that's putting people who have studios, fitness studios, in contact with people who want to do sport. And then we can also look at something like Spotify, which is also a two-sided marketplace. So they have reasonable margins here, but they have to buy the thing that they're then selling to the customer. So if I take an Uber, Uber's probably spent a lot of the money that they've got from me actually onto the taxi driver. Similar with urban sports, similar with Spotify as well. So here they have low margins. They have to think about software because they've got a platform to run, and they have to think about partners. So all of these things add to the cost and the complexity of running the business. Now, SaaS is the golden child of these business models. And the reason people love SaaS so much is because you just have to get the software, and then you sell the software as many times as you possibly can. And the costs of selling software are really low. So here you've got amazing margins. So you've got this very high margin business, but you have to reach a scale that it makes sense to invest in all of that software as well. So when it works, it can work incredibly well and be incredibly lucrative. And it's quite a simple business as well. You only have to really think about the customer and what you're offering them. Two-sided marketplace, many people here will be working for those. You have to think about the partners, the extra costs that are involved as well. So those are some introductions to some very clear sort of business models that we have. Next, you may have come across some of these terms. So we're thinking about, remember the two key things is, are we going to make more money with the customers? And how much is it going to cost us to get more customers? The first one is cost of acquisition. How much is it costing you to acquire one customer? This is ad spend, sales effort, marketing campaigns. How much is it costing you to get that one customer onboarded? Really important metric to know. Most companies will have some form of acquisition costs, and understanding how those are calculated and what they are super important for many product managers who might be doing some form of conversion optimization. The next one is churn. Churn is super interesting. Here, what we're looking at is the number of customers who are leaving us. It can be measured in two ways: the revenue, so how much were they giving us and now they've gone, or it can be the customers. So it can be individual customers or sometimes what's called logo churn as well. The next one would be basket value, basket cost. How much are people spending, and how much is it costing us for us to actually get that, to pay for that as well? So you'll see this on e-commerce, for example. And then here where I've got these little exclamation marks, it means that you need to, if you're dealing with these, you need to think about some of these definitions. Does it include VAT? Are you thinking about net profit? CAC, is it including staffing costs? Is it including the sales team? As we go on and we take a look at the average revenue per user, classic metric as well. So how much on average does each customer spend with us in a particular month, quarter, or year? Quite simple to work out. Really valuable information in terms of knowing how much value you're extracting from your customers. And this really impacts the profit margin as well. The next one is customer lifetime value. One of the most misunderstood of the KPIs that I think we deal with on a daily basis. Here we're dealing with how much is it costing, sorry, how much money is each customer providing on how long they're going to stay with us. So there's some element of prediction here, and it's very dependent as well on the churn rate. So if you improve your churn rate, you will automatically improve your customer lifetime value, and also you'll be getting a better value from your cost of acquisition. Investors often look at the customer lifetime value over the CAC, and this is the ratio between the two. Basically, the higher the better. If it's under 1, you're definitely doing something wrong because it's costing you more to get each customer the money they're providing. A good number, depending on the type of organization it is, can be about 3. And then one of the ones that I really like is the time to pay back the cost of acquisition. So this is measured in a number of months or years, and it's basically how long does it take us to get back the cost of acquisition. And by understanding these key metrics here, you should get a good idea about what levers you can pull in order to help increase the profitability, effectiveness of your organization, and really start understanding where your product bets make most sense. So, as I mentioned, churn is probably one of the metrics and the KPIs that we look at the most in product management. And the reason it's so important is because it has such an impact on the profitability and the revenue of a company. Because as I said, less churn means that you're using your CAC better, and it also means that you have a better customer lifetime value, and you hopefully will make more money, and people think you're more valuable as well. Okay, a little bit of a recap. So e-commerce has low margins. Sometimes it has a high cost of acquisition. You will be trying to get as much out as you can from those low margins. SaaS is the golden child. That's the one where once you manage to get enough customers, you're selling that software time and time again. It's very low, has very high unit economics. And then you've got these two-sided marketplaces which pop up everywhere, and those are one where it's somewhere in between. Okay, let's take some look at a real life example now. So one of the really interesting things about understanding more about finance is that you can start looking at different companies and seeing how they're different from one another. And a really interesting company to look at is Spotify, because you would think that Spotify is a music streaming service, they provide the music, but really actually what they're doing is they're a marketplace for people who have music to give it to people who want to listen to music. Now, if you're looking at something like, this isn't financial advice, but if you're looking at investing in something like Spotify, it's really important to know how profitable they are, how much money are they making, what do they spend it on, how effective and efficient are they? And there's this Twitter page, this website called App Economy Insights. So I haven't produced this at all myself. This is from a website that I definitely encourage you to visit. And they visualize this flow of money really well. And so what you can see here is we've got the money that's coming in, and you can see sort of the proportions that they're making from the free version of Spotify versus the premium version. And there's far, far fewer premium members of Spotify than there are of the free version. So this is already showing us something about the different value of different customers that they have. Then it comes in all as revenue here. And then you'll see that the ratio between these two is the gross profit margin. So what we're talking about, it's roughly what, let's call it a third. So third of the money that comes into Spotify, they can then use to pay their software developers, their marketing expenses, and the rest of it's going to the music labels. So we can see that there's, from the money that we get in, there's far less to then spend on things like R&D, sales and marketing than we might otherwise expect. So here, in getting these users in, having that sales and marketing cost, that ratio will be the cost of acquisition. The better we can use that, the more users we can get on. And what we're not seeing here, however, is things like the churn rate. How long are users staying for? How much money are we getting from those over their lifetime period? So Spotify could make more money, ultimately more money for their shareholders, if they can either get more users on for less, or they can keep them longer and they have a lower churn rate. So that's one side. It's a two-sided marketplace. Let's look at another one. Let's look at Duolingo. Duolingo is more like a SaaS company because they have their app. They're not buying anything in order to give you that service. So what we can see here is of the revenue that they get in from subscriptions, from advertising, from doing tests, in-app purchases, and wherever else they make money from, they keep so much more of it. Look at this. So from 151 million, they're keeping 110 million. And from here, they've got much more that they can spend on these R&D areas as well. Now, of course, it depends on the price that they're charging, but these are the different dynamics of these different businesses. And here, they've got their nice net profit at the end as well. Okay, so here you can see that there can be some subtle differences in the organization that you're working for, which changes how their sort of business dynamics works and how their profitability works. Now, the question here is, if you could buy either Spotify or Duolingo, which one would you buy and how much would you value it? So here, this question that you're asking, and they're both profitable companies, is how much are you going to pay for this goose that's laying this golden egg? So this is the profit that's coming out. And there's different models for it. So what you will do, or what investors will do, is they'll often use these things called multiples. So how much would they pay for a company based on the profits it's making at the end? How much should they think about the revenues that they're making? And what happens when these change? If you're dealing with a company which is very dependent on the economy and how it's going up and down, like construction, you might pay less. But if you're dealing with something like Microsoft subscriptions and everyone's going to pay for Office 365 almost no matter what, then you might pay more for that quality. So here, often use something like price to sales ratio. Sales is the same as revenue. Construction, so really old school industry, 0.3. So if you're buying €1 million of the sales of a company, you're going to pay 930,000. Retail, a little bit better. Let me just move this out of the way. Is for every million, you'll be paying 1.43 million. Now, for entertainment, and that might be something like Spotify, you can see that people are in general willing to pay more, 2.52. So for every million of revenue, you'll be paying 2.52 to own that. And then software, and this is where the SaaS thing comes in, 7.63. And this is one of the reasons why many companies are gravitating towards these sorts of SaaS products, because they see the valuations are higher and they could potentially sell the company for more. It's more valuable. Okay, super whistle-stop tour on finance terminology, how to look at it. But really the question is, what can product managers do next? Now, on a day-to-day basis, discussions about tech can seem far removed from finance. Now, they do ultimately, you're spending money of the company through the wages of the software developers that you're working with, and you're changing the behavior of the customers. So ultimately, you will have some form of financial impact on the company. So keep that in mind, even when it does seem it's a long way off. Understand the definitions. You'll sound really smart if you do. You can use them sometimes. You know, what are we looking for? Are we looking to decrease our CAC, or are we looking to increase our customer lifetime value? If you understand them and you can throw them in, you'll sound smart. Understand how these compare against targets within the industry, benchmarks, what the company is looking for, what competitors are worth, for example. You'll sound even smarter. And always be considering about what you'll be ultimately looking at: churn, basket size, acquisition costs. What is it that this piece of software development will do that will change one of those metrics ultimately? And then model, bring out a spreadsheet, work with your data people, and then you can be sometimes surprised at actually where you want to focus your time and what could have the best return on investment, especially when some of these things to target will affect more than one financial metric at the end. Okay, so that was everything. Thanks so much for the time to explain this, and I think it's time for questions.
Thank you, Allan. Thank you so much for this lovely session that you had. Let me just go back to this. Cool. So thank you so much for diluting this topic and making it really comfortable to follow through. And that being said, I think we are at the part which is the most interesting for the audience, and that's where the audience can really post their questions and we'll be presenting them to you. So we already have a couple of questions rolling in. Make sure that you post them on slido.com. You can either use the QR or use slido.com directly and use the code 1583527 to meet us there, from which we'll be pulling the questions. Or you can also use the comment section from the platform that you are streaming us from. So that being said, I'm going to buy you some time to post these questions and make sure that it gets to the speaker. While we do that, a little bit about product people. So these are the use cases where you could engage with us. First being the interim fraction product manager. We also provide product coach or consulting services and product discovery. This is a few of our B2C clients. This is not a complete list, but a few clients which you possibly already know of. Clients like Zalando, Backmarket, Freeletics, and Omio. We've also worked with B2B clients all the way from Plan, Cognigy, and Elucidate. So in terms of the product people stats, we have supported 300 cross-functional teams. We have 42 product leaders and product managers, with 62% of women in the team and 66% of them in leadership. So that being said, thank you so much for listening in. And we have the questions to our speaker coming in. Cool. So the first question is, how can product managers effectively translate financial metrics into actionable insights for product development and prioritization?
That's a great question. I think the first place to look at is um, working out where some of these metrics are coming from. So you'll see that if you interview and start speaking to other managers, leaders within the organization, that you'll have some topics that come up time and time again, things like customer acquisition cost, things like customer lifetime value. If you have those and you know how they're calculated, then you can look at, if you're looking at customer lifetime value, it's formed of how much are people spending and how much are they churning. If you go back to your user research, you'll probably start finding out reasons why people are churning and why the product isn't what they want, isn't what they expected. And then you can focus on some of those. If you can start bringing those up and bringing it back up through that chain, back up to revenue and profitability, then that will help you be able to define what you want to work on next. And if you're looking at acquisition costs, depends on the organization, but if it's sort of marketing and then you land on a landing page and then you convert from there, then you can also look at how your funnel's converting, and do some pretty standard classic funnel analysis, see where you're losing people. So just understanding cost of acquisition, customer lifetime value, for example, would be a good place to start, and seeing how those are built up, and having someone explain it to you as well will be really helpful as well. So a client that I'm working with at the moment, even though I've come across these topics before, I sat down with their CFO and said, how are these calculated? I sat down with the head of marketing and said, how are these calculated? So just go in, ask people, and I think you'll quite quickly see where the product to-dos will come from.
Cool. Thank you, Alex, for answering that. So the second question we have is, what are the most crucial financial terms or concepts that PMs should understand to communicate more effectively with executives and stakeholders?
Yeah, the ones they're using. So if they're using acquisition costs, cost of acquisition, customer lifetime value, try and use those. That will mean that you will speak the same language as much as possible. If you're looking at more on the sort of cost sides as well, then ask them about the profitability of the organization. Ask them about things like what's called runway, which is how much money is in the bank when they need to do their next financing round. Depending on where you are in the leadership ladder, those I would say would be some clear ones to look at. You'll never go wrong when you think about how much is it costing us to get a customer and how much money are we getting from the customers.
Cool. Thank you, Alex, for explaining through those concepts. And the third question that we have is, what are common pitfalls you see when smaller teams try to calculate CAC and LTV? Are those calculations straightforward, or are they hard to nail down?
Yes. So smaller companies and startups especially sometimes haven't defined them in a very industry standard way. So so customer acquisition cost should be reasonably easy to work out, because you look at a time period, how many customers did you sign up and how much did you spend in marketing and sales activities? However, sometimes the salaries of, for example, salespeople isn't included. Sometimes bonuses to salespeople is paid out later. So you just need to ask, like, how is it calculated? So that one's quite straightforward. Lifetime value of customers is based on churn, and if your churn rate is generally quite consistent, it's quite easy to work out. If it's quite volatile and goes up and down a lot, then it can be more tricky to work out, and you might have to sit with a data analyst and try and work out what would be the most appropriate definition of your lifetime value of a customer. And they can get quite complex as well. It's really a model that you're looking at. So yes, it can be difficult. No, it's straightforward, but somebody just needs to do the work. The numbers are usually there in most organizations. If they're
Cool.
not, try and find where you can get them from.
Cool. Thank you, Alex. The fourth question that we have is, assuming some people listening are product folks, how do you move from cost to profit center? Can you give a tangible example that is not too abstract?
Yeah, that's a great question, right? Because everybody wants to be part of a profit center. Um, I think the question you need to ask yourself is why you want to go from a cost to a profit center. Good leadership and management will understand that, for example, efficiency is important. So if you're working on something like payment, then payments are always going to be a cost for the organization. Banks want their money. But if you can show how effective and efficient the payment system or your processes can be, then I think that people will see value in what you're doing. Um, the actual cost of software development will always be a cost center. Software development's expensive, product managers are expensive, and it's about using those in the best way possible. I think it's really about showing how what you're working on will have a positive long-term impact on the financials of the organization, that you're increasing value. So you're increasing value in the product, the users see the value that you're creating, and that gives the opportunity that you reach more people or that those people will pay more. I think that's probably a good way to go down. I hope that
Cool.
answers the question.
Thank you for that example, Alex. The fifth question is, can you share a moment when you identified a potential negative financial impact of a product strategy and recommended a change to the strategy?
Yeah, this happens quite a lot. So the classic ones are you see that product managers and product teams are working on ideas that haven't been properly validated, and there's a high chance of those failing. So that has a negative impact on the organization because they've paid money to have that developed that then doesn't give a return on investment. So sometimes you see that discovery has been done on a particular area, on a particular product that's being developed at the moment, and it'd be better to rethink it. And sometimes you realize actually they're not going in the right direction, and it's better to pivot to something else to change the priorities based on that. So again, um, often what we're in charge of as product managers is being able to work on the return on investment of something. And if you're not developing features that aren't used, then that's going to help a lot with the overall financial situation of the company. Other areas that you might see could be neglected things. So payments failing, for example, bad debts cropping up later. Some of those real sort of boring nuts and bolts can actually have a surprising impact on the organization.
Perfect. Thank you very much. And next we have, can you provide examples of how a better understanding of financial principles has led to improved product decisions or outcomes in your experience?
I would actually say, in my own experience, I found it has been an incredibly valuable thing to learn, and has managed to help me have leverage and impact with many of the stakeholders that I work with. So understanding and getting information on cost of acquisition and customer lifetime value. I just used to smile and nod when people used to talk about these numbers. And I realized that every time someone was talking about, so let's say the head of marketing was talking about cost of acquisition, and I wasn't really thinking, is that high, is that low, what does that mean? I was missing an opportunity to improve things. And if I didn't know if this is good or bad, then I also couldn't direct the teams I was working with to help improve an actual financial metric. So from my own experience, I found it really invaluable to be able to understand these financial concepts, to just sort of see if things are going right or wrong, and be able to connect to those other stakeholders in the organization who will often talk in financial terms.
Perfect. Thank you. And the seventh question we have is, how can PMs balance short-term financial goals with long-term product vision and strategy when making decisions?
Yes, this is the million-dollar question. And it is one which you have to have a conversation with your leadership on. So we were talking about revenue at the top going to profit at the bottom. If you spend more money than you have, you're making losses. If you're making losses, the money has to come from somewhere. That money will often come from investors or debt. And sometimes the short-term goals are actually coming from the financing situation of the company at that moment. So the ability for a company to invest is really important to know and to understand. So sometimes there'll need to be short-term changes that are made based actually on that. Other times, let's say that your company has just received funding, for example, then that increases this horizon that you can then talk about investing into the future, and balance it from there. If you see something that you think is going to have a high impact in the long term, then it's important to investigate that and be able to explain it to leadership, for example. But a lot of the long-term, short-term cues will need to come from the leadership of your organization and the sort of financial situation that they're in at that moment. The flip side is looking at if you get a lot of funding and spending that in the right way. I think we all saw in sort of 2021, maybe even early 2022, there was a lot of spending going on. And that spending could have probably been done better, a lot of investment going on. But if you can come up with a really good idea about how you want to invest in the product and avoid things like huge projects, which end up not coming to customers quickly because you think, oh, we're safe, we've got money in the bank, then actually you still might want to stick to those really classic product management processes about being agile, getting feedback from customers, managing your risks so that you end up with products and features that are used.
Thank you, Alex. That's super interesting. And the next question we have is, what strategies would you recommend for PMs to stay updated on financial trends and metrics relevant to their product and industry?
Great question. It's nice to have a passion for these things. And I think product management is ultimately a very business-oriented role within an organization. I think the more that product managers understand about business, the better. I would say look at companies which are publicly listed. So you'll find news about them, people talk about them. If you type in like investing and then the name of a company on YouTube, you'll have thousands of results of people like, you should buy this company. No, you should sell it. It's too expensive. And you can really see some of the internal workings. So let's say that you're working at Babel, then you could look at the results of Duolingo that we were just looking at. And that will help you see in financial terms how those companies are doing. And you get some really interesting insights. And every publicly listed company, every quarter, will have a little meeting, which is public. You can generally like join it, or you can see recordings of it. And they'll go through their business. Like they'll go through all of these things, which you might be noticing in yours, and they have to tell you because they have to tell their public shareholders. And I'm sure if you tuned into the Duolingo quarterly update, you will find some fascinating things about what they think about the market, how much is it costing them to acquire every customer. Netflix the other day, or a few weeks ago now, announced that they weren't going to give people numbers of monthly active users. I mean, that's big. That's a big change in how Netflix is thinking about their company. Instead, they're just going to look at user revenue, whether that's from subscriptions or advertising. I mean, that's such a big change in the industry, and one that you can just find out freely. It's freely available. We get lots of people's opinions about it on Reddit and on the internet.
Cool. Thank you so much. And the last question we have for the day is, how do you know which model to choose when you want to start a business?
Yeah, I mean, sometimes it will be driven by sometimes it will just simply be driven by the problem that you're solving for customers. If I want to run a cafe, I'm going to have a business model which is most likely going to be opening some place that people can go. I'll pay rent for that. I'll buy some coffee beans. The coffee beans will then be used to give the customers their coffee, right? And there's probably some changes you could make to the business model. I mean, Starbucks gives you like a card that you load up, and then that's also a way that they make money as well. But generally, for a business like that, it's going to be more tricky. So the industry will define that. In sort of software, in SaaS, then there's all sorts of different subscription models. See what competitors are doing. I mean, many companies have changed their model from pay once to subscription services. And if you have the ability to test that and see how customers might react with interviews, surveys, then do it. And don't be shy about sometimes changing your business model as well. It can have a real impact on the profitability, the risks that are involved in running your business, and ultimately the valuation that you'll receive at the end of it. So yeah, take a look, see what other people are doing. Sometimes you'll have the ability to change it. Over time, you might also have the ability to change it, but it's not a decision that should be taken lightly.
So thank you so much, Alex, for that explanation. So that being said, please do subscribe to our newsletter where we will share some of the most interesting topics in terms of product management. And we do have a next live stream set up, which is hiring great product managers, candidate-centric recruitment by Hassan, who's a lead product management consultant at Product People. So thank you so much. Thank you, Alex, for all this information that you have shared with the audience, and especially for making this topic as brilliant to understand with the interactive way that you approached it. Thank you so much. And thank you so much to the audience that have been listening. Make sure that you tune right in for our next live stream as well. And please bring a friend along. The more the merrier. So thank you so much and have a nice rest of the day. Thank you.